welcome again. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is October 14th of 2022. This is our Friday Insights edition. And what we do is we try to go a little bit deeper, share some financial insight that you normally wouldn't get from our market insights and observations that we have on Tuesdays and Thursdays for you. I had the honor and privilege earlier this week to attend the Forbes Shook Top Advisor Conference in Las Vegas at the Wynn earlier this week. And it did not disappoint. In fact, I'm going to show you some slides of the great minds in the world of finance and economics, as well as investment management, that I had the privilege on a one-on-one basis to interact with. You know, one of the things that was most impactful for me and for our clients at Blanke Schein Wealth Management is when we attend conferences like these, we have actionable ideas, ways to allocate capital, ways to protect capital, especially in bear markets or recessions, or even bull markets and expansions. And so both Rick Jr. and myself have the opportunity to constantly stay at the cutting edge as to what the world of finance and investments have to offer. And that's our responsibility to continue to stay on the cutting edge so that we're doing the best for our clients. Now, the professors that I got to meet with, Professor Jeremy Siegel from Wharton Business School, almost 20 years ago when I had my investment consulting designation there, Professor Siegel taught me, and I had the pleasure to reconnect with him once again. There's a photo of me with Professor Siegel, and he was on CNBC the next day. I'm going to put the link in for everyone to jump to his interaction on CNBC, his layout of his thoughts about the Federal Reserve right now and how they're overdoing it and where we are with our current market, as well as the recession that's impending on the United States and the impacts of that and how that will ultimately play out in the equity markets. So I encourage you after this to go watch what Professor Siegel said actually at that conference. We also had Dr. David Kelly, the chief strategist for JP Morgan, top names from BlackRock and a few others that are around the investment world. And it was just an exceptional opportunity to see even Kathy Wood from ARC Innovation, who's sticking to her guns on her investment philosophy, even though, you know, a lot of her investments have not worked out at all, but she's sticking to her guns. But it's good to see a portfolio manager up there with such high conviction when she's completely wrong at the same time. And so we also have seen Ron Insana, his former CNBC contributor. There's a photo of Ron and I as well. But the overall experience itself was best practices sharing from all the other advisors across the United States and how we're thinking about and caring for who are most important to us. And that's ultimately our clients and our family, and how we get through even the good times and the bad times as we're navigating through these tough waters for our clients. That being said, you know, Chris Davis of the Davis Funds, and I've known Chris for many years. We've allocated investment capital to the Davis family through the years. He brought up a slide that puts a lot of this into perspective. The first research point he pointed out said that for everyone in this room since since 2000, so just 22 years ago, that $1 that's in your pocket back then is now worth 57 cents. And that's the ravages of inflation. So everything costs more because of inflation. Even before the last couple years of the CPI read that we're seeing, the Consumer Price Index, what the governments read and what we're paying for everywhere from everything at the pump to on the kitchen table and the grocery store. That being said, his point was that's the reason why we have to invest in equities, because equities and real estate over the long haul are going to outpace inflation. In the meantime, that's the price you pay. Markets go up, markets go down. We don't really have a crystal ball as to when everything turns around one way or another. But what we do know is, historically speaking, over time, you have to have an inflation type hedge. And some of the best ever have been equity markets over the long term. So that perspective is really important. And then he put up the second slide, which I just recreated for us right here, saying, going back to 1928, if you look at the S&P 500 annualized and you say, hey, listen, what if we did have that crystal ball? What if we were to sell at the right time and buy at the right time, or maybe halfway get it right? Or maybe what's the long view of just buying and hold, right? If we own quality, we like what we own, we know what we own, we know kind of businesses they are, we know that they're durable and they get stronger on the other side of a recession. What if we just, we own those companies that are going to be stronger on the other side? What if we just buy and hold? What does that return look like on an annualized basis versus the other two? And so let's go to the board and check it out. So if we're looking at last recessions, if you could call a recession, right, by this hypothetical and say, hey, if we sold the 1 year before a recession starts, okay, and then we bought back in when the recession ended, your annualized return is 9%. So your crystal ball is pretty good on the S&P 500 over time. A 9%, that's not bad at all, annualized over year. What if you were to sell 6 months after the recession, in the recession? So we know we're in the recession. Now we start selling and say, hey, listen, just get me out because I don't want to be through this recession. It doesn't feel good, especially with the markets being down. And then you buy back in when everyone says all clear, recession's over, which there really never is the all clear signal when a recession over. But just for the hypothetical, they did the math for us. It's an 8.1%. In terms of annualized return, if you were basically were to guess it correctly both times, if you will. But if you just did the buy and hold strategy, you're looking at an annualized rate of return of 9.7%, which is better than both. In fact, by quite some, if you take into the account of the compounding over time, that little bit of difference between on returns, mathematically, the power of compounding really adds up. So what this example actually shows is there is the advantage of owning quality and just buying and holding, as we can see, because that compounding adds up over time. And it's very important to take a longer view. And that was great about the conference itself. It provided a lot of perspective, even though, we're in a bear market, we're seeing bear market rallies. We're using that for our clients as to rebalance and trim portfolios, but also take advantage of investments that we haven't had the opportunity to invest in because they've been overvalued. So we will rebalance, and we'll also take advantage of some tax loss harvesting. We do this for every client in our taxable accounts. We comb through, and between now and year end, we say, okay, what worked, what didn't? Let's reallocate the capital. Let's book some tax losses so that you could offset any potential capital gains that you may have with us here at Blanke Schein Wealth Management, or even outside your balance sheet, right? Maybe you did a real estate transaction, or maybe a business transaction where you have cap gains. So we really want to take a look at, and we'll be checking in with our clients on a case-by-case basis. And if you have a specific, hey, listen, Rick, Rob, I have a cap gain exposure this year, please let us know proactively, because we can take advantage of offsetting from a tax harvesting standpoint strategically for you in your portfolio here at Blanke Schein Wealth Management. That's our Friday Insights. It's a recap of the Forbes earlier this week. It was a great conference. Kudos again to Rick Jr. for making 40 under 40 here in Palm Springs Life. That's one of the reasons why he couldn't attend with me in this conference, but maybe there's always next year as well. Thanks, guys. Have a great weekend. And if you have any questions or need anything, we're here for you. Thanks for watching.